Okay. And I am going to trouble here with Zoom, I think, because we had Pablo in here at the beginning, but we should be okay here in a second. Okay, you can see my screen now, and let's go ahead and put up our slides. And okay, good. Let me get rid of my Zoom taskbar there and put my machine into tablet mode. And looks like we're good. Okay, good. So what I want to do now is go ahead and pick up, guys, where we left off last time. And as we had concluded, we were talking about the financial statements that entities are required to prepare. And of course, we know from our discussion that the Financial Accounting Standards Board, which we're abbreviating as FASB, right? Financial Accounting Standards Board, is the entity that sets accounting standards, and then companies are to follow those standards when they prepare their financial statements. Of course, the SEC is up there as the federal government agency that is watching over the FASB to make sure that they're promulgating generally accepted accounting principles that will help primary users, investors, and creditors to make investment and credit decisions. And this is important that companies all follow those standards so we can compare company A to company B. We're trying to decide between Apple and Microsoft, let's say. Then we know that we can compare them because they're both preparing their statements following the same standards. The financial statements that entities are to prepare are their balance sheet, income statement, statement of stockholders' equity, and statement of cash flows. And then we have footnotes, and those footnotes elaborate, expound on the information that's in those financial statements. Now, in this class, in the early going, we will mainly focus on the balance sheet and the income statement. We'll get to the statement of stockholders' equity in its entirety. Really, when you finally get to 1B, 1C, they'll be looking more detailed at that. At this time, we're really going to be focusing on one part of the statement of stockholders' equity, which is something called the statement of, and it's retained earnings. And we're actually going to look at that here in a couple of seconds. That's a statement of retained earnings. And remember, guys, I know as I squeeze things in, sometimes it's hard to read that. It's best to just sort of hear what I'm saying. I'm saying statement of retained earnings. And then we'll get into the statement of cash flows in other chapters, other classes. I'm not sure if it's 1B or 1C, but you'll get to that in a later class. Okay. Now, as we look at our financial statements here, and we had kind of started this last time, we start to look at them, and we start with the income statement. We call it the income statement because on the income statement, an entity reports their net income. Hello, very, basic thing. We call it the income statement because entities report their net income on the income statement. How do you calculate net income? Your net income is going to be your revenues minus your expenses. So we have revenues, we have expenses that we incur in generating that revenue. Whatever's left over is our net income. Okay. Now, once we have our net income, we then go ahead and put it into our retained earnings. Now, the way I like to describe retained earnings to my students here at the beginning, when you're first understanding about these financial statements, is by drawing this little picture here. And I ask you the question, what do you think this thing is? That's a question. This is more of an art question than an accounting question.
So, so basically, you kept some profit in the
What
company
is this
to.
picture? My question is, what is this thing?
Is it a pig?
Good. It's a pig. Very good. Usually I have to put a tail on there, okay, but for people to get it. And let me ask you a question. What did the pig say when the farmer grabbed him by the tail? Any guesses? Okay, the pig said, "This is the end of me." Okay, all right, so we have what? We have this pig. Now you know why I became an accountant. I'm sure you're all just cracking up there at home. Okay, so what happens? We have this pig. Okay, this is our piggy bank. And what happens? When you first start a business, and I guess we're assuming that this company started this business on September 1st, they had what? They had nothing in the piggy bank. The piggy bank was empty. And then they went ahead and they did what? They put their income after they had made some money and paid some expenses. They had a little bit left over, right? And I think that's where you were going, Shalini, with that. They had a little bit left over. They stuck it into their piggy bank, right? Okay. Now what happens? You put some money in your piggy bank, but every now and then you want to go to the movies, you want to have some pizza or whatever. So what do? You come and you pull some money out of your piggy bank, right? So you take that little stopper out of the piggy bank, you pull some money out. We call that a dividend. We call that a dividend. Dividend means that we are dividing our earnings out to the owners of the company. Remember, we said that what? A corporation is a separate legal entity from the owners. So the owners hold stock, and every now and then the managers, probably the board of directors of a corporation, will make a decision to take some of the income that's been earned by the entity and divide it out, pay it in a dividend to the owners. So if you pay something out, do you retain it? No, you're not retaining it. You're paying it out, and you pay it out, you divide it out to the owners. And so every now and then we pay a dividend, and then we are what? Left over with the ending balance in our retained earnings. We made some money, we put some money in our piggy bank. Then what? Periodically, we pull some out in the form of a dividend, and we end up with an ending balance. Now, what I use is a mnemonic to help you remember the pattern for the retained earnings, our piggy bank. We have beginning balance. We add what? We add net income. We subtract. That says subtract. Even I can't accept that as being written clearly enough. Okay. We subtract our dividends, and then we have what? Then we have an ending balance in the retained earnings. So a good way to remember that is BASE, the beginning balance, whatever we started the period with. When we start the business, we start with 0 in our piggy banks. We add in our piggy bank, we add net income, we subtract our dividend, and then we have an ending balance in our retained earnings. Now, Shalini, I had sort of cut you off there. Was there something you wanted to say more about this statement of retained earnings?
No, I was studying the same. So thank you.
Okay, good. Okay, now what happens when you go to the next slide here? We have our retained earnings. This was just continuing over from the previous slide. And then we come to our balance sheet. Now, why do they call it a balance sheet? They call it a balance sheet because it balances. And what we are going to see, and we're going to look more at this, is assets. The total of our assets are equal to our liabilities plus our stockholders' equity. Okay. And so right now you just need to understand that the balance sheet balances, assets are equal to our liabilities plus our stockholders' equity. And what I want you to understand right now for our stockholders' equity, they're made up of two different accounts. One is common stock, and we'll talk more about that here in a couple of minutes. And the other is what is the retained earnings. And you can see that the retained earnings is basically the ending balance in retained earnings that gets pulled down from our statement of stockholders' equity. Okay, so we'll talk about statement of cash flows in later classes, and there's more to the stockholders' equity than just how we calculate retained earnings, but that comes in later classes as well. For right now, we're just interested in the retained earnings part of our stockholders' equity when it comes to reporting the changes over the period. Okay, so even though we have a statement of stockholders' equity, we're just going to focus on the statement of retained earnings piece at this time in this class. Okay, question. Now you come over and
I have a question.
Yeah, sure.
So on the last slide, it doesn't really matter for us right now what common stock is and stuff, right?
Right at this very moment, I'll give you a little more elaboration on common stock as we go into our discussion here today and going forward a little bit. I'll talk about it where you really start to get into how to account for stock transactions in 1B, 1C, but I will give you a little bit of flavor for that now, because there it is, right? And it's kind of hard to completely ignore it, but the nuances of that are covered in different classes.
Okay, thank you.
Mm-hmm. Okay, any other question? Okay, good, guys. Now, a statement of cash flows is another statement way down the road. Don't worry about that right now. Although it is, I don't want to, it almost sounds like I'm discounting it, like it's not an important statement that users would be interested in. It's a very important statement in that regard, but we're not ready in our understanding of accounting yet to really get into that. It'll come up later. Okay. Okay, good. Now, as we've said, assets equal liabilities plus stockholders' equity. So let's start to get a sense of what some of these elements of the balance sheet are. Remember, we saw the balance sheet. They call it the balance sheet because it balances. What balances? Assets equal liabilities plus stockholders' equity. And we know that our stockholders' equity right now is our common stock and our retained earnings. So what are these other pieces, assets and liabilities? Well, assets are things that have future economic benefit. Assets, by definition, have future economic benefit. Okay, so by definition, assets have future economic benefit. So let me ask you a question. Is cash an asset? That's a question.
Yes.
Yes, cash is an asset because you can turn it into any future economic benefit you want within the confines of the law, right? So if you have 20 bucks in your pocket right now, what happens? That 20 bucks is going to be your lunch later, right? Or whatever it is, okay? That's the future economic benefit, okay? Is equipment an asset? Say a vehicle that you have that you're using in your business.
Yes.
Yes.
Yeah, sure. You can use that vehicle to make deliveries or whatever it is you're talking about, right? Okay, good. Now you look at liabilities, okay? Liabilities are our bills. Liabilities, I'm saying it funky like that on purpose, are our bills, okay? So let's think about this for a second. Let's say you have $100 in one pocket, and in your other pocket, you have a $40 cell phone bill. Well, do you really own that entire $100? No, you're going to have to do what? Take $40 of that 100 and pay it to what? Pay your bills, pay it to the cell phone company. So really, your what? Your stockholders' equity, your ownership. Stockholders' equity represents what's left over of the assets that belong to the owners of the company. And in a corporation, the owners are stockholders. Our ownership is really what? Only $60 of that cash, that asset that's in our pocket. So when you look at the balance sheet, we're saying to you what? What are our assets? What are our future economic benefits? But what are our obligations to take some of those assets and pay our bills? We call those liabilities. And then that difference is going to be what? What we actually have left over, what we own. What is our stockholders' equity? What is our equity? What do we own of those assets? Question. Assets equal liabilities plus stockholders' equity. This equation always stays in balance. If this equation is not in balance, it means the accountant made a mistake. Assets always equal liabilities plus stockholders' equity. If I have a balance sheet that doesn't balance, it means I made a mistake and I have to go and fix it. Assets equal liabilities plus stockholders' equity. Okay? Question. All these slides are doing, guys, is just giving you the definitions of what I had just mentioned. And at this time, our stockholders' equity is really going to be our common stock and our retained earnings. It's not till later classes that you really kind of start to jump into, other elements, if you will, of stockholders' equity. Question. Okay, good. If there's no questions, then let's go ahead and let's look at this slide, guys. And I apologize. I know this slide is a little sloppy, and I think I'm intentionally making it a little sloppy. I don't know if I'm intentionally doing it. I'm accepting the sloppiness of this because I want to make you realize later that it's going to be important that we follow a very, very formal system, which is really the subject of this class of 1A as we go through and actually prepare a financial statement, okay? But I'm gonna go ahead and start with this sort of, sloppy little one here for us. And let's say we are sitting in our house and we don't have any money. If you're sitting in your house and you don't have any money, are you happy? Probably not. I know people say, well, money doesn't make you happy. Who are those people? The people who have money, okay? People who don't have any money are probably saying, well, I'd probably be happier if I had some money, right? So you're sitting in your house, you don't have any money, and you say, how can I possibly make some money up in here? I need some money, right? And so you look out in your yard and you see that you have a lemon tree back there. Okay, you have a lemon tree in your yard and you sit there and you say, I wonder if I could turn those lemons into money. Now, let's say that you paid, let's say you paid $20 for the lemon tree and there are 20 lemons on the tree. How much did those lemons cost you each? I have $20 I paid for the lemon tree, 20 lemons on the tree. How much did each lemon cost me? Cost me to get that, each lemon.
$1 each.
Good. And am I saying your name correctly, Shalini?
Yes.
Yeah. Shalini, you answer all the questions you want, okay? But I'm going to point out to the rest of the folks here. Accounting is something that you get better at the more you talk about it, the more you run it through the speech center, the more you get over your fear of hearing yourself talk about this stuff, the better you get. Just sitting there and kind of, halfway listening while you're watching TV and halfway listening while you're watching the clouds fly by or whatever is not the way to learn accounting, okay? Accounting is a focused person's discipline. You gotta watch, you gotta pay attention, you gotta be engaged, okay? So let's this is not an economics class. where you sit there and you look at the supply and the demand curve and you go, oh, isn't that pretty? I'll learn that the night before the exam. Okay, you need to sit there and you need to be engaged with this stuff, or I promise you, you're going to be going to the tutoring center that they had up here and say, I have no idea what I'm doing. So you need to stay engaged, you need to focus, participate. Okay. All right. So what happens? We're sitting here and we have this lemon tree that we paid $20 for. There's 20 lemons. And so they cost me $1 each. Now what happens? I go ahead and I say, okay, I'm going to make money off of those lemons. Now what I'm going to do is I'm going to form a corporation, and I'm going to bring the lemons that I own personally, and I'm going to bring them into the corporation. Remember the example with the barber chair where I had that antique barber chair and then I brought it into the company? Okay, so I'm going to take these lemons that I own personally, and now I'm going to bring them into the corporation. Now, at this point, I want to make sure that everyone understands, I don't mean everyone in the class here understands, the world understands that I own those lemons. But now they're in a separate legal entity, the corporation. So what do? I take back $20 of common stock from the corporation. So I'm showing that I own the corporation. And since I own the corporation and the corporation owns the lemons, I have connected my ownership of those lemons, not by saying I own the lemons anymore, but by saying that I own the corporation that holds those lemons. And so that stock represents now my ownership in the corporation. So now the separate legal entity, the corporation, prepares its first balance sheet. And its first balance sheet are what? Do the lemons have future economic benefit? Yeah, presumably I'm thinking I'm going to be able to sell them, right? So they have future economic benefit. So I show my assets of $20 and my owner's equity now. Never mind this other stuff, guys. I want to cross it out, but it never seems to want to fully cross out. But my owner's equity is what? Is just my stock. It's the stock that the corporation, a separate legal entity, issued to John. And they're saying, you know, there's owners out there, John in this case, that hold what? Hold stock in this corporation, and we issued it worth $20 worth in order to get those lemons from John. So now the corporation is showing you I have assets of 20, and I have stockholders out there that hold what? $20 worth of my stock. Does the balance sheet balance? Assets equal what? There's no liabilities, so it is simply what? Simply owner's equity, the stock of $20. Question. Okay, good. So my first balance sheet balances. Now I'm going to go ahead and I'm going to make my first income statement.
I have a question.
Sure.
You said that other people can own the stock of your $20 stock. Am I right?
I mean, other people.
I think that's what you said, that like you have the $20 stock and someone else can or other people can invest in that stock or something like that.
Okay, you want to buy into this corporation right now?
Sorry?
Would you like to buy into this corporation right now? I could issue you some stock too. Do you want to join the corporation right now before we get going on this income statement?
So if you issue stock to her, could you issue like 10 of the 20? And then it'd be like 10 and 10?
No. I asked a question, Selena, do you want to buy some stock in this company?
Yes.
Okay, sure. Okay, give me $1 and I'll issue you share stock. So what happens? I go ahead and you give me $1. If you give the corporation $1, do they have any cash?
Yeah.
If you give a corporation $1, do they have cash?
Yes.
Okay, so I go ahead and now instead of just putting lemons, I'm going to also say that I have some cash. I have $1 of cash. I have to squeeze it in. $1 of cash. Where I want to write this cash. I'm trying to write a dollar sign, and for some stupid reason, I'm trying to write the dollar sign on the other side of the dollar. So now I have $1 of cash. My total assets are how much now? That's a question.
That'd be
Huh?
21.
21. So now I have $21 of assets. And because I just issued $1 worth of stock to you in exchange for your cash, now the stock is 21, isn't it?
Mm-hmm.
So the corporation can issue the stock not only to me, because I went ahead and I brought in the lemons, and the lemons had value, and they gave me $20 worth of stock in exchange for $20 worth of lemons. In your case, you gave me cash, which is often the case, by the way. And in exchange for the cash that you gave me, the $1, I issued $1 worth of stock.
Mm.
Now you own, $1 worth of the corporation, don't you? Because you gave up some of your cash in exchange for that $1 ownership.
Mm-hmm.
$1 worth of ownership.
Okay.
Okay. Now, are you okay with that?
Yeah. Yeah.
Okay. Now, completely separate thought. Okay. Now, let's say I decide, let's say I go to potential investors. And I say to you guys, I've got this great idea for lemons, man. These lemons are going to kill. These are going to be the greatest lemons ever. You didn't talk about lemons, dude. Don't even get me started. And so you sit there and you say, wow, that sounds really great idea, John. I'll tell you what. I'll give you $25 for all the stock that you own in the corporation right now. And I look at that and I say, okay, if these fools want to pay me $25, then I'm going to go ahead and I take it. So I take the $25 from you. I take that $25. I'm now have no ownership in this business anymore because you took my stock. My stock was $20 where it was my representation of the ownership. If you give me $25 and you take the stock, now you own the corporation, and I'm going to go to the Cayman Islands and hang out. I'm going to leave the country and I'm going to start my life over there with this $25, right? I'm not involved anymore. Does the corporation have any more money than it had before that transaction occurred?
No.
No. So there would be no impact on the financial statements at all as the stock trades in the secondary market against trades in the market, I should say, I don't know why I'm saying secondary, trades in the market amongst shareholders. That has no effect on the corporation's financial reports. The only time that stockholders' equity account will change for our purposes right now is if the corporation decides to issue additional stock, which is what happened, Celine, when you came through and I issued you an additional share of stock and you brought in more resources into the corporation, right?
Right.
Okay. So I don't know if that was maybe part of where your question was.
Yeah. Yeah. Thank you.
Okay. Question. Any other question? I'm going to erase this notion here that we issued additional stock, and back to the fact that right now there's only lemons in the corporation, and the corporation has issued me, John, stock. Now, I don't want to sell the lemons for $1 each, because if I do, I've only recovered my costs, and I want to make a profit off of this thing, right? And so I sit there and I start to try to differentiate my lemons. How am I going to make them special so that someone will pay more than $1 each. Any thoughts? Come on, my future business, you're coming out of De Anza College to show us how good a business folks you are. Go ahead.
You can label them organic or say they're grown a certain way.
Okay, let's say
Advertising them,
huh?
advertising them.
Let's say I'm going to go ahead and advertise them as the most organic special lemons on the face of the earth. I don't know. Maybe I just sit there and I keep spinning the lemons on a table and everybody goes, look, spinning lemons. Let's pay more for them. Whatever, right? Okay. So someone says, hey, those look like really, really special lemons, John. I'll pay you $3 for each lemon. Strike that. I'll pay you $5 for each lemon. Sorry, I forgot my own example here. I'll pay you, no, what is it?
No, it's
$3. Sorry, guys. Stupid example. I forgot how much I sell these lemons for. I'll sell them. I'll pay you $3. So I'm able to sell the lemons for $3 each. Let's say I sell 5 lemons. 3 times 5 is 15. And so because I've been able to sell those lemons in my business, in my normal course of my business, I'm a lemon, rancher, whatever I am here, 5 times 3 gives me revenue of $15. I report $15 as revenue on my income statement. Now, I have to show on my income statement what was the cost of the thing that you sold. And since I had paid what? Remember, we said $1 each for those lemons. And so $1 times the 5 lemons sold means I have a cost of lemons sold, a cost of goods sold is the term we'll start using for that generally. Cost of goods sold of $5. I have a gross profit of $10. Gross profit says revenue minus the cost of goods sold is gross profit. Now, nobody wants a skinny gross profit. Everybody wants a fat gross profit because it's saying this is what's left over now to cover my operating expenses. What did I have to incur in order to even have a business here? Okay. And so I have this gross profit of 10. And then I look at my lemon tree and I've picked off 5 lemons and the tree's looking a little shaky. And I say, I'm going to go and I'm going to get some fertilizer for that tree to make sure that it's in good health, right? So what do? I go to the fertilizer store. I reach into my pocket and I hand the guy $7 cash. In exchange, the nursery owner, the fertilizer store owner, gives me a $7 bag of fertilizer. I take that bag of fertilizer and I dump it on the ground next to the tree. Wouldn't do much good if I didn't dump it next to the tree. I dump it on the ground next to the tree. Now, if I dump fertilizer on the ground, does it have any more future economic benefit? And don't get me into agricultural accounting. Just think for a second, dumping something on the ground. Does it have any more future economic benefit?
No.
No,
No, if you dump it on the ground, it doesn't have any more future economic benefit. So I report it as an expense because any future economic benefit associated with that has expired, hasn't it? It's expired. So I call that an expense, and I'm saying it funky like that on purpose. Expense means that the future economic benefit has expired. So I have my my revenue, my $15 minus the cost of what I sold. The $5 worth of lemons that I sold gives me gross profit of 10, and that's left over to cover my operating expenses. And I just had operating expenses of $7 because I dumped that on the ground. There's no more future economic benefit. So I report fertilizer expense of 7, and I have net income of $3. Okay, now where does my net income go? Let me give you a little clue. Where does my net income go?
Into the piggy bank.
Good, into the piggy bank, which we're calling a statement of retained earnings. And in my statement of retained earnings, I'll have what? I'll have the beginning balance. What was the beginning balance in my retained earnings when I just started this business?
21.
20.
What was the beginning balance in my retained earnings when I just started the business?
Oh, 0?
0. Retained earnings is not common stock. Retained earnings is what? The beginning balance. I add what? See what I mean about being focused in accounting, guys?
Your net income,
Good, right? The
then you
stockholders'
subtract,
equity is, I just want to make sure we're clear on this. Stockholders' equity is our retained earnings in our common stock, but for our retained earnings, it's beginning balance, add net income, subtract dividends, gives me what? Ending balance. That's what I'm doing right now. I'm doing my piggy bank. There was no stock in there. Okay, it's the beginning balance. I add my net income. How much is my net income? How much is my net income?
$0.
3.
Oh, 3.
$3. Good. I don't know why I'm having trouble with my dollar signs today. Beginning balance is 0. Net income is $3. Okay, good. Did I pay any dividend?
No.
No.
No, didn't pay any dividends, so that's 0.
Mhm.
And so the ending balance, see if it's going to let me write down here. Yeah. Ending balance in my retained earnings is how much?
$3.
$3. And so now when I prepare my balance sheet, and let's just start with the stockholders' equity section, I still have stock of $20. Forgetting the example that we had with Selena, I haven't issued any more stock. It's just the $20. That $1 was just a side discussion. I've done what? I've issued the $20 of stock. That's the $20. And now I have what? Now I have retained earnings of $3, don't I? So my stockholders' equity is my what? Is my stock
Common stock
plus
and-
my retained earnings of 23. Question? Did somebody say something? Okay, so I have my stockholders' equity, which is what? $20 of stock. I issued the stock at the beginning of the corporation, haven't issued anymore, plus my retained earnings. And I just showed you how I calculate that beginning balance, add my net income of $3. No dividends. So the dividends were 0, gives me ending balance of 3. So 20 plus 3 is 23. And now let's prepare the asset part of the balance sheet. So what happens? Let's start with the lemons. I had what? I had 20 lemons that cost me $1 each. I sold 5. So I have what? 15 left. 15 at $1 each means that my lemons are now showing what? $15, but I have another asset now, which is cash. How do I calculate my cash? And for some reason, my students have trouble figuring out cash, and I can never understand why, because the cash account is like your wallet. The cash account is like your wallet. So what happens? I sold what? $15 worth of lemons, didn't I? I sold 5 lemons, $3 each. So I had $15 of cash. But I spent what? 7 on the fertilizer. So the ending balance of cash is what? Is this $8. So 15 plus 8 is 23, isn't it? $15 worth of lemons, $8 worth of cash is 23. Does my balance sheet balance? Do my assets equal my liabilities or 0? Because I didn't incur any liabilities. So I just have what? Stockholders' equity. Now the common stock plus the retained earnings. Does the balance sheet balance?
Yes.
Yes.
Question. You have a question? Did you see any rabbits jump out of any hats? Was there any magic here? No, there was simply what? Accounting for transactions as they happen and making sure that my what? Balance sheet stayed in balance as I went through that process. Question. Okay, good. Let's so we had a pretty successful year for our first business. For our first year in business, we made $3. Okay. Now you come over and we go and we say, well, let's go into our second year now. In our second year, excuse me, guys, my throat has been giving me some trouble, so forgive me for clearing my throat all the time as we go through this. But I go through, and in the second year now, I decide that I'm going to continue to sell my lemons for $3 each. And this year, I sell 7 lemons. This is year 2 now. I sell 7 lemons. So if I sold what? 7 lemons in year 2, and I prepare my year 2 income statement now, 3 times 7 is 21. So I report revenue of 21. The lemons cost me what? $1 each. So $1 times the 7 lemons gives me a cost of goods sold of 7. I have a gross profit here of what? Of 14. Now, gross profit of 14. And what companies tend to do, especially in the early stages, is if something worked in year 1, they'll probably go ahead and do the same thing in year 2. So I go back to the fertilizer store and I say, give me the $7 bag of fertilizer. And the guy looks at me and says, weren't you in here last year? And I say, yeah, I was. He says, aren't you that Lemon Ranch guy that's making a big splash with lemons? And I say, well, yeah, matter of fact, I am that guy, right? And so he says, I'll tell you what, you don't have to pay me right now. I'll bill you. Pay me later. In fact, pay me next year. You don't have to pay me this year. Pay me next year. I'll just bill you. Don't worry about it. Now, why do you suppose this fertilizer guy is willing to open up an account for me?
Because if he sees that you're successful, maybe he wants in, because if your business is booming and he's constantly like getting supply from him, then his business will have like a reoccurring like boom every year.
Yeah. He's looking at it, hey, this dude is going to have a whole lemon ranch at some point. Instead of buying $7, he's going to buy $7 million worth of fertilizer off of me. Good. I mean, credit is what made America great, guys. And it's not, you're not supposed to get into politics. Trump made America great. Biden made America great, whatever you're thinking. Credit is what made America great. You look around, all these buildings and houses. I mean, you see the Bay Area and all the assets you see around were all created off of credit. That before the Depression, we talked about the Depression in before the 1930s and all that. If you wanted a house, you had to pay cash for the house, and nobody had the cash for the house. So what happened was the federal government came in as part of trying to revive the nation from this barbaric calamity that happened, the Great Depression. The federal government came in and said, banks, we will back the loan. If you loan somebody to build a house and the person can't pay you, we'll indemnify you. We'll give you that money that you loaned to the individuals that weren't able to pay you. But when the banks heard that, they started lending money. And when they started lending money, people built houses. You build houses, what happens? It's not just the house. It's all the furniture that goes into the house. The fact that if people have a nice house, they perceive a certain growth in wealth. So they decide to buy a car. You buy a car, and people tend to think, oh, well, just the car dealer makes money. No, the guy who makes the little felt that goes along the window also makes money. The guy that makes the little light that blinks on the side also makes money. The car companies don't make every single thing that goes in those cars. So you have an expansion in the economy that comes through credit. That's why, in my personal opinion, it's a little silly to hear people say the federal government should stay out of business. Meanwhile, the federal government's whole job is to do what? Is to encourage, to promote business through various policies and whatnot. Going back to the 30s, one was the creation of the Federal Housing Administration, the FHA, that said, we will back the loans. If people can't pay you, go ahead, banks, make those loans. And that started this big spur of the economy. Okay, so anyway, credit is important. Okay, so we have what? We have this on credit. Now we take the fertilizer. We don't have to pay the guy yet. We take the fertilizer, but what do? We do the same thing we did last year. We dump it on the ground next to the tree. Does that fertilizer have any more future economic benefit if we dump it on the ground?
No.
Agricultural accounting, huh?
No.
No.
It's an expense. Good. It's an expense. So we report the expense, even though we haven't paid the cash yet for this fertilizer. We have a bill for it. We haven't paid the cash, but it still has no more future economic benefit. So we report an expense. So we have what? We have this gross profit of 14, expense of 7. We have what? Net income in our second year of $7. Now we go and we prepare our little piggy bank down here. Obviously, I like drawing this thing. Okay, I'm going to make them bigger so I can just fit everything inside the piggy bank. Okay, and we have what? We have beginning balance. What's our beginning balance? Well, what was last year's ending balance?
$3.
3.
Last year's ending balance was 3. So year 2, right? This is our statement of retained earnings now for year 2. Good. The beginning balance was what? 3. What do we add to our piggy bank?
7.
Net income, which in this case was what? $7. Good. Did we pay any dividend?
No.
Not yet. Dividend is 0. Ending balance is therefore what? 10.
Mm-hmm.
3 beginning balance, add net income, no dividend. Ending balance is 10. 3 plus 7 is 10, right? 10. Our common stock is still the same, $20. Year 2, we didn't issue any more stock to anybody. So it still sits there at $20. Common stock stays the same until we issue more stock and somebody gives us something in exchange for that. None of that has happened. Okay, so the common stock is still 20. But now we have what? We do have a bill, don't we? We owe the fertilizer guy the $7 because we never paid him. And so we have what? We have 7 plus 20 plus 10. So our total, our stockholders' equity plus our liabilities is how much? Our liabilities plus our stockholders' equity is how much?
27.
Our liabilities plus our stockholders' equity. Our stockholders' equity is common stock.
37.
This is how much?
37.
37. Right? Stockholders' equity is common stock and retained earnings. 20 plus 10 is 30. Plus the liability is 7. That's 37. Good. Our lemons, let's do that. We started out with what? We started out with 20. We sold 5 in year 2, 5 in year 1, 7 in year 2. So we've sold a total of what?
12.
12. 20 minus 12 is what? $8 worth of lemons that are left. Don't worry about the lemons rotting, okay? I know lemons don't last 2 years, but suspend reality here for a second. 20 minus 5 minus 7 leaves me 8 lemons. And I guess lemons don't have 2 M's in them is the other thing. Okay, but don't worry about that. I put 2 M's on these lemons because they don't rot. Okay, so $8. Our cash is what?
$1.
Last year we had what? We
$1.
ended the year. No, last year we had what?
Oh, 8.
$8 last year. And this year we acquired how many more dollars? 21 more, didn't we? Because we sold the lemons.
Yes.
We had 21 this year plus the 8 from last year. So we have what?
29.
$29 now. We didn't pay the fertilizer guy yet for year 2. So 29 plus 8 is 37, isn't it?
Yes.
Does my balance sheet balance?
Yes.
Did any rabbits jump out of any hats?
No.
Yeah, I'm a little confused with the second part, just the cash and the lemons. If you could just go over it again, please.
Yeah, sure. So I started the year, where's the best place to write this? Because this thing gets a little messy here. I'm going to put it over here. Okay. I started the whole business with how many lemons? Let's do the lemons first. How many lemons did I have to start the whole business? Dollars worth.
8.
20.
To start the whole business, how many lemons did I have?
20. 5.
How many lemons did I have to start the whole business?
Just 20 or
Huh?
just 20?
20. I got a lemon tree with 20 lemons. How many did I sell in year 1?
5.
I sold $5 worth in year 1. How many did I sell in year 2?
7.
7. So if I sold 5 in year 1 and 7 in year 2, how many am I left with?
6.
8.
Okay, guys, 20 minus 5 minus 7 is how much?
8.
8. If you need a calculator, then get it. In fact, God made calculators for accountants. God looked down on accountants and said, oh, they're doing all this work without calculators. Let me invent calculators. Let me create calculators. Okay. So calculators are for accountants. Okay. So when I ask you a question, like you had 20, and I tell you to subtract first 5 from that, you hit the minus 5. Then you hit the minus, if I tell you to subtract 7, you hit the minus 7. And then you can hit equals, and looky, it gives you the answer. Use the calculator in this class. I know that in some, arenas of education, they say, well, don't use a calculator because, I don't want you to burden yourself with doing math in your head when we're trying to do the accounting. I'm the worst person in the world of calculating numbers in my head because I'm thinking about how am I going to report these numbers, and I will use a calculator for almost everything. Okay, so 20 minus 5 minus 7 gives me what? 8 lemons that are left. So when I prepare my balance sheet, I look at the lemons that are left, I count them, I see that there's 8 left, and I report the lemons. $8. Now I'm going to do the cash. And when I look at the cash, I started out with what? I started out with year 1. I had the amount of cash that was left in at the end, I'm going the wrong way. the amount of cash that was left at the end of year one was what?
$8.
Mala? That's correct, Elizabeth. Mala, $8. You see where we got the 8?
Yes.
Okay, so I started out with the $8. Okay, and then in year two, I did what? I sold 7 lemons for $3 each, didn't I?
So it'd be the 21.
21, and then I didn't spend any of that $21 cash because when I went to the fertilizer store, the dude said, "Don't worry, pay me next year," right? And so
I have a quick question then. So like
my
if
year two cash, hang on, year two cash was 21. So the ending balance in the cash is 29, isn't it?
Yes.
Mala?
that's Elizabeth talking, but yes, I
I
understand.
know. Huh?
But I am curious. So like just aside from everything, so say if you did spend the $7 on the fertilizer, would that be incorporated in this equation?
Well, let's not think of it as an equation. Let's think of it as your wallet. If you had $8 in your wallet and you put $21 in your wallet, if you spent any of the money in your wallet, would the amount of money in your wallet go down?
Yes.
Okay, so if we had paid, say we paid the dude the $7 rather than get the credit, then the cash would be down $7. It would have been what, $22? But I wouldn't, what would it be?
No,
What would it be?
$14.
No, $8 is what it started with. 21 minus
Oh.
7 is
$22, you're correct.
22.
Yes.
Okay, so it would have, the amount that would have come in year two, maybe I should do it that way. Maybe that's where you're going, would be
Yeah.
14, and then we'd have 22, right? It's your wallet, guys. Don't freak out about this. It's your cash is your wallet. How much cash did you start with? Think about it. New Year's Eve, you have $8 in your wallet. You wake up January 1st of the second year. Is there still $8 in your wallet?
Yes.
Yeah, I mean, unless you have friends that are sneaking in the middle of the night while you're sleeping, taking money out of your wallet, you should still have $8 in there, right? So you wake up the next morning, there's still $8, and during the year, you add 14, then at the December 31st of the second year, you should have what? $22, right? Guys,
That's correct.
right?
Yes.
Yeah.
Okay, okay, good. Now, in this case, I assume though that he didn't pay for the fertilizer. We didn't pay for the fertilizer. So let me put the 21 back, and now it's 29, right?
Yes.
Okay. Elizabeth or whoever, somebody was to ask a question, I told him to wait. We're good now? Whoever was trying to ask a question?
Yeah, we're good.
Okay, okay, good. So now when you look, Mala, and now you look, you see where this $29 worth of cash came from and the $8 limits, right? And then 29 plus 8 is what?
37.
37, $7 of liability, $20 of common stock, $10 of retained earnings, the beginning balance plus what I added, my net income minus the dividend. There was no dividend. So that gives me $37 worth of stockholders' equity. Does the balance sheet balance?
Yes.
Yes.
Did any rabbits jump out of any hats?
No.
No. Question. Okay, now let's deal with this dividend thing. Let's say, because, you know, I'm the lemon guy, right? But John wants to go and buy some soda. So I sit there and I say, well, I need to take some money out of the corporate accounts so that John, the human being, can go over to, you know, Quick Stop and get some soda. Okay, so I go ahead and I pull $1 out of the corporate accounts. Well, what I'm doing is I'm paying a dividend. So I pay myself $1 dividend. Now the ending balance in the retained earnings is 9. If the ending balance in the retained earning is 9, what's the total amount of stockholders' equity now? If the amount in the retained earnings is 9, what's the amount in the stockholders' equity?
36.
Good. 36.7 plus what? Plus 20 plus 9 equals what? 36. Okay. So I've got $36 now in my stockholders' equity, but I took money out of the corporate accounts, didn't I? So the corporation no longer has what? $29 of cash. How much cash does the corporation have left now?
28.
John, the human being, $1. Good. Now the corporation has what?
28.
$28, and 28 plus 8 is how much?
36.
36. Does the balance sheet balance?
Yes.
Question. Assets equal liabilities plus stockholders' equity. Assets are things of future economic benefit like cash, lemons. Liabilities are our bills. If we owe an amount to somebody that we're going to have to pay a bill for stuff that we took and used in our business, that's a liability. Our stockholders' equity is what? Whatever we've issued in common stock. Stockholders' equity will not change unless I issue more stock. And I don't care if the people that bought the stock can be trading that stock all around the world until somebody comes back to the corporation and says, give me stock, corporation. Common stock stays the same. My retained earnings is the other part of my stockholders' equity. And it's my piggy bank, beginning balance plus my net income. Where do we report net income? On the income statement. How do we calculate it? Revenue minus expenses gives me net income. That goes into my piggy bank. I add that to my retained earnings. If I have a dividend, do I have to have a dividend? Must a corporation have a dividend?
No.
No, often startup corporations won't pay dividends because they're saying, hey, we're taking this money and we're going to retain it. We're not going to pay it out in the form of a dividend because we're trying to grow the business here. We're trying to develop the business. Older corporations, more mature corporations, yeah, they might pay a dividend out, right? Okay. And so we pay out a dividend, we subtract that, gives me ending balance in my retained earnings. If you pay a dividend, the corporation didn't retain it, they paid it out. They divided it out. Okay, so we subtract that from my retained earnings. Asset equal liabilities plus stockholders' equity. Okay, so on the income statement, report net income. How do you calculate net income? Revenue minus expenses. So what do you report on the income statement? Revenue and expenses. So let me ask you a question. Is cash reported on the income statement? Is cash reported on the income statement?
Yeah. Yes.
Yes.
It is. Where? Show me an account called cash here. Go ahead.
Oh, no, no, no.
Is cash reported on the income statement?
No.
No.
Cash is reported where? Where do
Balance
you
sheet?
report cash?
On the balance sheet.
Balance
Things
sheet.
that have future economic benefit like cash get reported as an asset, good, on the balance sheet, good. Is revenue reported on the balance sheet? Is revenue reported on the balance sheet?
No,
No.
No,
No, it's reported on the income statement.
Income.
Why on the income statement? Because we report net income on the income statement, and income is calculated as revenue minus expenses, right?
yes,
Good. Guys, this is the boot camp part of the class. I'm gonna keep drilling you like this until we are all talking like the same soldiers here, okay? Question, soldiers in the same war here. Question. Okay, good. Now, if you think about the equation, assets equal liabilities plus stockholders' equity, okay? The most dynamic part of our stockholders' equity really was what? The retained earnings. Common stock kind of sat there, didn't it? Okay, and whatever it was, the $20. Okay, but what changed was what? The retained earnings. For example, if we think about year one, retained earnings started out at what? 0, but then we had revenue, and now I'm going to tax my own memory here. What was our revenue in year one?
21.
Year one,
Oh, 5.
I think it was $15, right? What was it in the first year?
It was 15.
15. Okay, our expenses were what?
7.
7. And so now why do we have, oh no, because I forgot the cost of the lemons. So the revenue was 15. The cost of the lemons was what? Was 10. And then we had the $7 of expenses. So that gave us what? $3. The dividends were 0. So the ending balance to retained earnings was 3. Okay. In year two, then it was what? 21 minus what? Minus 7 minus 7. Why am I messing this up? 7 times 3 was 21 minus the, what was my cost of lemons sold in year two was what? 7 times 1 was 7.
Mhm.
7 was my income. 14 in year one? No. What am I in year two? What am I doing?
No, that's year 2. The 21 minus 7
Right.
is year 2. Minus 7 for expenses, your net income should be 7.
Okay, thank you. Yeah, thank you. Net income was 7 in year two. Okay, and then I had what? So revenue minus expenses really is net income. And then in that last little example, I had what? I had $1 worth of a dividend. Okay, so that's why it became $9. Okay, so the thing that changes is what? Is the retained earnings, because retained earnings, you have the beginning balance, you add the net income, you subtract the dividend, which I'm not getting any teaching prizes for my little example down here. I should have just stuck with what? Beginning balance plus net income minus dividends is how you calculate the retained earnings. Even though they're showing revenue minus expenses, revenue minus expenses is what? Net income, right? Okay. Question.
Shouldn't the 10 be 5? Because you said it was the cost of each lemon.
Yeah, I was confused on that
10
too.
be 5. What 10 be 5? Huh? Oh,
Well,
5.
under
In
revenue.
year
Right here.
1.
Right here. Yeah, you're right. 10 minus 5 is 15 minus 5. Thank you. Is 10 minus 7 is 3. Yes, you're right. Okay. Question. Okay, good. So let's look back now. Let's look back at our thing that we looked at. We looked at this earlier. Revenue minus expenses give me what? Net income. That's what's reported on the income statement. Revenue minus expenses gives me net income. Where does net income go? Where does net income go?
On the income
Incomes-
statement.
Income statement.
It's shown on the income statement, and then where does it go? It's put into my piggy bank.
Piggy bank.
Your retained
into my
earnings
retained
statement.
earnings. Right, I go to the statement of retained earnings. Beginning balance when you start the business is 0. Add net income. Subtract any dividend. That gives you what? Ending balance in the retained earnings. And then that gets reported what? On the balance sheet along with my common stock. And so I take my what? Liabilities plus my stockholders' equity gives me my total liabilities and stockholders' equity. And that balances with what? With my assets. Assets are things that have future economic benefits, such as cash, such as equipment, etc. Right? Guys?
Right.
Yes.
Question. Okay, now one more thing before we conclude today, and I'm going to put my tablet in laptop mode, and I guess it didn't turn off the camera. Okay, sometimes it does that, but I want to do something real quick before we adjourn for today. Okay, because you look at all this and you think, okay, well, that's all cute, you know, John and lemons and, you know, cute. Okay, but let's do this. Let's go ahead and let's take a look at, and I should probably clear my cache. So obviously I'm interested in the Super Bowl. And let's look at Apple 10K. Okay. You guys have heard of Apple, right? Okay. And let's see if we can find their 10K for 2022. Okay. Now, this that you're seeing here is the report that Apple needs to issue to the Securities Exchange Commission. The federal government, okay, sits there and tells corporations that they have to issue something like this 10K. Okay, so I'm going to go ahead and I'm going to open this 10K. And of course, it put me right back where I was because I have my computer set up in a manner in which I have to tell it what software I wanted to open it with. So I'm going to open it with the Acrobat. Okay, and you know, there's all kinds of things that the Securities Exchange Commission, the SEC, tells a company that they have to provide to them. And as part of that filing, they are to prepare financial statements. Okay. Now, when you click on financial statements, they start to list the different financial statements. For example, remember we talked about notes, but let's just look for a second. Reports of independent registered companies, okay, a public accounting firm. And you look, and what you see on the screen here is the opinion on the financial statements that comes from the auditor. Now you look at this and you say, who cares? Well, this is telling you that a third party, a CPA with a license, with experience, with having passed exams, keeping up their education, taking ethics classes and whatnot, have looked at these financial statements and told you that, and when you look, we say, they say that, where is it? In our opinion, the financial statements present fairly in all material respects the financial position. Financial position is the balance sheet. And the results of operations, that's the income statement. And the cash flows, and then whatever the period is that's being covered, companies tend to issue comparative statements that cover a series of years. Okay, so they went ahead and they said, yeah, we looked at these financial statements and they do this now, and they're fairly stated. That means that somebody can do what? Somebody can rely on these statements. Now, I want to go back, and I can't seem to see how to go back from here. And so it looks like I'm going to have to close this stupid thing and open it again to show you what I want to show you. There's another way to do it, I'm sure, but I can't figure it out at this point. Okay, so now I go back and I look at those financial statements. I've looked at that report of the independent auditors. And now I'm going to look at the consolidated statement of operations, which I've said is like the income statement, right? Okay, even though they don't call it income statement, it's a fancy name for the income statement, is statement of operations. And I have what? Sales minus cost of sales gives me gross margin. Gross margin and gross profit are synonymous. They mean the same thing. Different terminology to mean the same thing. Then I have what? Then I have my expenses. And remember last time we were talking about all research and development is treated as an expense. And then I have selling and administrative expenses. I have my operating income. And then there's some other things that we really won't get into in this class that would be separate from operating income. But ultimately, we come down to what? Net income. Is that what we just looked at? Sales minus what? Minus cost of sales gives me gross profit, gross margin, minus my expenses gives me net income, right?
Yes.
Just like we saw. Only now we're talking about a multi-billion-dollar and hundreds of million-dollar corporation, whatever. Okay. Now we keep going. And we come to the balance sheet. Why do they call it the balance sheet? Why do you call it a balance sheet?
Assets equal liability plus shareholders' equity.
Good. We call it the balance sheet because it balances. Good. And so we have what? We have total assets. And that balances to what? That balances to total liabilities plus stockholders' equity. Does this thing balance?
No, it's unbalanced.
Come on, guys. Do you think Apple possibly would have an unbalanced balance
Oh,
sheet?
wait a minute.
Okay.
Sorry.
Okay, that's all right. It balances, right? Okay. And then what? And then we have what? We have our liabilities, their bills, plus what? Plus their stockholders' equity, and their stockholders' equity is common stock, and retained earnings is in there, isn't it? Okay. Now, guys, you know, they have some other things, but we're not ready for that yet. Remember, I said there are other things that constitute stockholders' equity. For our cases, it was just common stock. For our purposes, for this class, it's just common stock and retained earnings right now. Okay, there's other things, but once you added in the common stock and the retained earnings and these other things that we're not ready for yet, it matched the amount of it balanced to the amount of the assets, right? Okay, so the point of this part of our discussion today is simply to show you that the statements that we've been looking at have what? Have applicability into, you know, an entity we're all very familiar with, Apple. And then when we get to our statement of retained earnings, beginning balance minus what? Minus dividends. Guys, there are other things that affect retained earnings at this point in time that you probably won't even get into this until you're studying intermediate accounting. Some cases you're not going to look at this until you're studying for the CPA exam. Gives me what? Gives me the ending balance in my retained earnings. Beginning balance, add net income, subtract dividend. Don't worry about these other things. Gives me ending balance. Okay. So although what? Much more simple, more bells and whistles, maybe a little more complex. than when we talk than what we're talking about in this class. Notice the primary chunks, I mean, probably 80–90% of what's on here is what we talked about in our simple little example a minute ago. Okay? Question. I don't know why these days they hide my open files from me. When I say they, I mean my computer likes to hide things from me that I know I have open. Guess I'm gonna have to do it this way. I know it's open because I know I didn't close it. Okay, well, it's gonna go ahead and refuse to cooperate with me, so I'm gonna have to go the long way, which is it's gonna make me go through all this to open a file that I know is already open. Maybe it wasn't open, okay? I guess I closed it. Welcome back here. Okay. So what we will do next time is we will continue on with an exercise that is going to show us how we will keep this whole equation in balance as we go through and we consider a series of transactions. And this time, instead of scratching the numbers all over the place, we're going to be using sort of an Excel approach. And then we'll go through the practice midterm together, which are also contained in these slides. And frankly, guys, you should be able to start to answer some of these questions now. So in prep for our next class, you may want to look at this, but we'll go through it together. And depending on our time, we may even start into chapter 2 next time. Okay. Question. Okay, guys, I will see you on Thursday, right? And in the meantime, I would recommend you spend a little bit of time taking a look at, maybe even taking a look at that exercise, but definitely probably taking a look at some of this stuff, and we'll jump in it together next time. Okay, guys. Any questions? All right. See you next time.
Thank you. Bye.
Yeah.
Bye.
Bye.